Today's highlights: BlackRock made a massive purchase of Bitcoin worth $568 million, pushing the price up to $73,000. But whether it can stay stable like this is questionable. The RSI has been broken, and with the funding rate turning negative, can Bitcoin hold its ground? Strict regulations on crypto advertising may signal the end of the era of covert operations. It's Thursday, March 5th. This is TV Chinese Channel Billion, and I'm Michael. Now let's look at the most important data from the past 24 hours. Before we get started, a quick announcement. This Thursday at 8 p.m., it's our exclusive Radar Volatility members session, where we provide one-on-one support to help our members with the issues they care about. We've been doing this for 6 years now. All right, let's get to the headlines. Recently, Bitcoin has seen a very noticeable rebound, right? A very important driving force behind this is that ETF funds have started to flow back in. According to the data, the US spot ETF saw a single-day net inflow of $683 million, with BlackRock's iShares alone buying $568 million. So, the big players are buying the dip. Driven by this influx of funds, Bitcoin instantly surged by 7.5%. with the price quickly approaching around $73,000. Looking at the on-chain structure, there's a metric called MBI that can help us understand whether this rally is fundamentally driven or speculative. This is known as the Balance Index indicator. This indicator, when combined with open interest in futures contracts and on-chain transaction activity, is currently between 0.3 and 0.6, which is considered a relatively neutral range. Simply put, this round of price increase is driven by institutional capital inflows as well as some sentiment. However, if you want to interpret it as a reversal signal, you would need to see continued and stable inflows into ETFs, and at the same time, the indicator should gradually fall back into a healthier range. Only then could this rebound possibly evolve into a structural recovery and challenge. All right, just yesterday, Bitcoin touched $73,000, and today there are already unusual movements in on-chain data. Today, there was a net outflow of 28,700 Bitcoins from exchanges. This is the largest single-day outflow since October 2025. Generally speaking, when a large amount of Bitcoin is withdrawn from exchanges, we see it as a bullish signal, because investors usually only transfer coins off exchanges when they are preparing to hold for the long term or move them into cold wallets. Now, the Bitcoin reserves on major exchanges have rapidly dropped from 431,700 to 437,100, decreasing by about 24,627 Bitcoins. Among these, there was a single large transaction. 23,588 Bitcoins were transferred in a single transaction to a newly created wallet address. So, taking all these factors into account, this looks more like an internal wallet adjustment or a cold wallet migration by the exchange, rather than a large holder cashing out all at once. So, although it appears on the surface that large amounts of funds are leaving, in reality, it may just be the exchange moving funds internally. Therefore, how significant is this as a reference for the market? We will continue to monitor these on-chain abnormal addresses for everyone. Now, let's look at what happened in the Bitcoin derivatives market yesterday. There was a very noticeable change. The funding rate started to turn negative. The funding rate is essentially the periodic settlement fee between longs and shorts in the perpetual futures market, and it's also a very important indicator for judging market trends and the direction of leverage. So, looking at the data from the exchanges. On that day, Binance's funding rate was about 0.005, and BitMEX's was around 0.007, which were both relatively neutral overall. However, Bybit's rate dropped directly to negative 0.033, marking the lowest funding rate since October 2025. A negative funding rate usually indicates that short positions are increasing. In other words, quite a few traders are betting that the price of the coin will continue to fall. However, what's interesting from past experience is that when the funding rate becomes extremely negative, but there hasn't been a large-scale sell-off in the spot market, it actually shows that the market is in an overly pessimistic emotional phase. So if the price continues to fall, those high-leverage short positions may be forced to close, which could trigger a short squeeze and actually drive a rapid price rebound. All right, please like this video and turn on the notification bell. Why do we keep emphasizing liking and turning on the bell? Because liking is a way to support our 6 years of providing free news content. And as for turning on the notification bell, even if you don't have time to watch the whole program, just glancing at the daily push notifications titles will give you a general idea of what's happened in the crypto world over the past 24 hours. We try our best to make the titles simple, direct, and clear. All right, let's look at the news. Right now, with this rebound, everyone is wondering if this is a reversal, if it's time to jump in and buy the dip. Let me tell you, think back to the bull market in 2021, the bear market in 2022, and even earlier, the bull market before that and the bear market in 2019. When did it not drop so much that everyone started doubting life itself? People said blockchain was a scam, that Bitcoin was causing harm, that nothing was worth it anymore. Only when everyone's emotions hit rock bottom does a real reversal appear. So, many important market turning points are born when everyone feels there is no hope left.
The latest report from K33 Research points out that Bitcoin has entered a historically rare state of extreme oversold, with the weekly RSI dropping to historic lows. Technically, this usually means that the selling pressure is nearing its end, rather than there being more room to fall. Continuing to expand.
I think it's quite difficult to reach a new high this year, but actually, as we often say, this is actually the best timing.
Research Director Vetle Lunde stated that when the RSI remains below 30 for an extended period, it often indicates that selling momentum is waning and the market is gradually approaching a technical bottom. At the same time, perpetual contract funding rates have turned negative and put option premiums are rising. This reflects that market sentiment has clearly shifted to extreme pessimism. From historical experience, such periods of extreme bearishness are often more likely to be followed by a rebound.
Yesterday, I helped a beginner who just entered the crypto world and downloaded an exchange for the first time set his Bitcoin bottom fishing price. When the price soared to $72,000 yesterday, he was really eager to buy in right away. I told him to buy the dip, not the rally. The price I set for him because he was impatient was $70,000, with lower levels at $62,000 and $58,000. So, in your opinion, at what price drop in this round would you consider it a bottom fishing signal? Go ahead and write your price in the comment section. Once the price goes up, we'll look back and see whose bottom fishing range was the most impressive. So the signals we need to watch right now are, first, whether the market sentiment has reached extreme panic. When everyone thinks it's all over, that's when a turnaround often appears. Second, after a sharp price drop, the downside space is usually quite limited, so gradually buying in batches at this time actually increases the cost effectiveness. Third, the ones selling most aggressively now are short-term funds, while long-term holders have barely moved. This provides support for the medium to long-term trend. However, everyone should also remember this. RSI is not a magic indicator. Under extreme emotions, it can wear everyone down until no one has any patience left. And whether Bitcoin is at 60 or 70,000, it actually makes little difference compared to a future price of 200,000. All right, the next piece of news may be relevant to every KOL and everyone currently creating in-depth content in the crypto space, because X is the most active social platform in the entire crypto community. Its rules have changed. X recently updated a key rule regarding paid advertisements. In other words, if your content is a paid promotion, you must label it with a paid partnership tag. At the same time, you can report any advertisement or ad post that is not properly labeled, and these reports can be made anonymously. It may seem like just some ordinary rules, right? But for the entire crypto industry, this could change the way many KOLs make money.
According to X's latest policy, any creator who publishes paid promotional content related to a brand or project must label it as a paid partnership, allowing users to distinguish between advertisements and regular content. At the same time, the platform has also adjusted its reporting mechanism. Previously, complaints had to be made via email, but now they can be submitted through an anonymous report form. Even without an X account, you can submit a violation report. Under the new rules, covert promotion is becoming increasingly difficult to pull off. If you label something as a paid partnership, fans may question the objectivity of your recommendations. If you don't label it, you may face post deletions, feature restrictions, or even account suspension due to reports. Some accounts in the industry have already been penalized for violating promotional rules, and some are now considering moving to exchange-based social platforms, such as certain communities.
If somebody's going to try to blackmail me with advertising, blackmailing with money, go fuck yourself. Is that clear? I hope it is. Hey Bob, you're in the audience. Take Twitter, for example. Our Twitter account only has just over 30,000 followers so far. To be honest, Twitter isn't very welcoming to creators like us who mainly focus on video content. It's still more geared toward images and text, right? This time though, I noticed that a lot of people started playing with memes right from the beginning. All of my posts are labeled as ads paid for by Elon Musk. You can tell that people are actually not satisfied with this upgrade, but the reason given by the platform is very simple: to separate ads from genuine opinions and make the platform more transparent. But the problem is that the crypto industry itself is highly profitable, and there's a lot of gray area for marketing. I think advertisers will definitely come up with even more varied forms of ad collaborations. But after this rule change, the space for making money by manipulating emotions and driving traffic through covert means will be squeezed. In a more transparent environment, the ways of making money will likely be reshuffled. We believe that in the future, the anxiety-driven atmosphere on Twitter may decrease. Six companies have reached a consensus on AI choosing option B. What will AI use as their trading tool? The Korean stock market has triggered a circuit breaker with 550 billion in market value evaporated. Will the cryptocurrency market continue to be under pressure? All right, our lobster is now not only leading trades, but has also started small-scale decentralized contract experiments on platforms like Polymarket, Hyperliquid, and S. Once the results are out, I will share them with everyone. First, our community friends can enjoy the benefits of this training together. Now, have you ever thought about this? Right now, AIs already have their own social groups and forums, but if AIs really want to trade and exchange value with each other, this would involve high-frequency, small-value transactions, and the lower the friction, the more conducive it is for AIs to trade with each other. So, the research team at the Bitcoin Policy Institute conducted an experiment where they placed many AI models into an economic system environment. They let the AIs choose for themselves which currency to use for transactions, and the result was something even the researchers hadn't anticipated.
The study tested models from 6 companies: Google, DeepSig, XAI, Mini, Max, and 2 others, totaling 36 AI models. In 28 simulated economic scenarios, the AIs were allowed to independently choose their currency to complete functions such as storing value, accounting, payment, and settlement.
Today, Bitcoin remains an incredibly dominant and influential part of the global landscape of digital crypto assets. And these crypto assets continue to evolve rapidly in today's financial market. Represent approximately 7% of assets in the United States, but the speed at which stablecoins are growing and expanding is actually significantly more rapid than what we've seen with traditional unbacked digital assets.
The results show that in long-term holding scenarios, 79.1% of AIs chose Bitcoin as their first choice, while stablecoins and fiat currencies together accounted for less than 13%. In payment and settlement scenarios, stablecoins led with 53.2% and 43.4% respectively. Bitcoin accounted for 36% and 30.9% respectively. Notably, none of the models chose fiat currency as their first choice.
All right, so the models from these 6 different companies, without any prompts or background information, all reached exactly the same conclusion. For storing value, they prefer Bitcoin, while for transactions, they lean more towards stablecoins. This logic is actually very similar to many predictions. Bitcoin is like digital gold, while stablecoins serve as everyday payment tools. Now, here's a question. Let's take it a step further. When one day the world becomes fragmented, when the US dollar weakens, when the fiat currencies that stablecoins are pegged to begin to collapse, and when on-chain stablecoins are no longer stable, what will AI choose as a payment tool? Let's discuss this together in the comments section. Yesterday, there was a very stark contrast. Bitcoin broke through $72,000, but the Korean stock market dropped to the point of triggering a circuit breaker. Of course, Korea is an economy that is completely dependent on energy imports, so when there is disruption in the Middle East, oil prices will rise, right? When oil prices go up, it's not just manufacturing and transportation that are affected. Even exports and financial market expectations will experience a downward shift. So, the sharp fluctuations in the stock market this time are not essentially because the Korean economy has worsened, but rather, global capital is rapidly pulling out of risk assets. So in other words, when the shadow of war appears, the market's very first move is to buy safe haven assets.
This week, the Korean stock market experienced a historic drop. The benchmark Kospi index plunged about 12% in a single day, marking the largest decline since 1980, and triggered the exchange's circuit breaker mechanism, pausing trading for about 20 minutes. The market downturn was mainly driven by geopolitical risks. The escalation of tensions in the Middle East pushed up oil prices, and about 70% of South Korea's crude oil is imported from the Middle East. This has triggered investor concerns over energy supply and the economic outlook.
Circuit breakers and sidecars have started happening on an unprecedented and massive scale, leading to what appears to be a completely uncontrollable and rapid decline.
In just 2 days of this sell-off, $550 billion in market value evaporated, and the Korean won hit a 17-year low. With funds fleeing risk assets, the tech-heavy Korean stock market saw heavyweights like Samsung and HKEX plunge, deepening the slide.
Although this downturn in South Korea isn't the worst in history, it can still be considered a historic drop. As you know, before the decline, just the AI sector in the Korean stock market had risen by nearly 50%. There's also a very important characteristic of the Korean stock market. Participation is nationwide, and the involvement of young people is extremely high. Last year, there were even more people speculating in cryptocurrencies than in stocks. This year, people have shifted from the crypto market to the stock market, so funds are jumping back and forth between the two markets. As soon as there's any fluctuation in risk, both the Korean stock and crypto markets come under pressure. So in the short term, if you want to see the kimchi premium, you'll have to wait. I estimate that it will be around October. All right, let's take a quick look.
The recent Solana airdrop events have been as lively as rush hour, according to the latest data. The network's daily transaction volume has surpassed 40 million transactions, with DeFi and bot trading crowding in together, packing the block space to the brim. Some people joke that Solana isn't a blockchain anymore. It's a blockchain expressway. Stablecoin giant Tether has recently increased its holdings of U.S. Treasury bonds again, and its current holdings have already exceeded $90 billion. Simply put, they issue stablecoins on one hand and use the money to buy government bonds and earn interest on the other. Some people joke that Tether is becoming more and more like the invisible bank of the crypto world. Competition among Ethereum Layer 2s is getting fiercer, with networks like Arbitrum, Base, and Optimism seeing continuous growth in total value locked as both developers and capital keep migrating over. The logic is actually very simple. When the mainnet is too expensive, just build a highway. The problem now isn't the lack of Layer 2s, but that there are so many Layer 2s that users are starting to get lost. Tron in the Telegram ecosystem has seen rapid user growth recently. The launch of wallet, mini-games, and payment features all at once allows many users to use blockchain directly within the chat app. Some say this might be the most down-to-earth adoption of Web3 yet. After all, everyone uses chat apps every day. The NFT market, which has been quiet for a long time, has recently shown some signs of recovery. Trading volumes for some blue-chip projects are starting to pick up, and market activity is a bit better than in previous months. However, many veteran players joke that the current state of the NFT market is that it's not dead, but it's still slowly recovering.
All right, today isn't about giving you a quick fix, it's a warning. As you all know, in the workplace, it's rare for someone to suddenly pull far ahead of you in just a day or two. But now that AI has arrived, whether it's in the crypto world or in the workplace, there will only be 3 types of people. Those who don't know how to use AI. The second type are those who can use AI but are just average users. The third type are AI experts, and that's where the real difference lies. So when you're still complaining that others are better than you or that the environment is unfair, some people have already started improving themselves in ways you can't see and have begun seeking out tools to help them grow. When real opportunities arise, those who are prepared will naturally be more easily noticed. As a result, outsiders only see the outcome, such as promotions and raises, but overlook the process behind it. In reality, there has never been such a thing as sudden success in the workplace. Every seemingly effortless victory is the result of long-term preparation. Truly smart people don't wait for opportunities to come before they start working hard. They make themselves worthy of being chosen first. Remember, all the luck you see is actually the result of being prepared. That's all for today's program. Within it, we've included all of our membership benefits. We hope you'll become a member and join us in working hard and striving together. Change gradually if you have money you'd rather meet.